Dr. Rajiv Kumar, Vice Chairman of Niti Aayog, joins us right here on ET Now. As far as the Q2 GDP numbers are concerned and the GV at 6.1%, GDP numbers at 6.3. Dr. Kumar, thank you very much for being with us. Do you believe, and congratulations, things are beginning to look up, many would say, but do you believe this is a pause in the downward trend, or is this where the Indian economy begins to look up from?
Very well put, Supriya. I think you're good at this. A pause? No, not at all. I've been saying this for the last 2 months, ever since we talked earlier, that we have the bottoming out in July, and the numbers will look up from then on. And I'm quite convinced that that is the case now. That this is the beginning of an upward cycle, upward trend for the economy, and you will notice that. Not only has the manufacturing, jumped after 5 quarters, it's 7.3. The IIP has turned up as well. Our core sector numbers are good, but more importantly, the PMI for manufacturing still remains below 50 in October, despite a small dip, and that for the services is now 51.7, which has been increasing for the last three months continuously. So, if that is taken as a leading indicator, I'm quite convinced that this is not only the beginning of economic recovery, but an acceleration, but the beginning of a accelerated economic recovery as we go forward. And and therefore all the naysayers and all those who have been talking about the economy now plummeting and plunging into deep depression, etc., must I hope will recognize that this is time for recanting.
All right, this is time for recanting. From 5.7, we've gone up to 6.3. Things will only accelerate from here on if you listen to one of the key policymakers in New Delhi. But Dr. Kumar, one of the things that I want to speak about particularly is the gross fixed capital formation. That has grown by 4.7%, which I believe is a welcome sign. But if you actually look at it from a growth point of view, as a percentage of growth, it's not such a substantial increase. And at the same time, you have to talk about government spending. That cannot go on relentlessly. So the government has front-loaded its spending. We presume that the spending cannot continue at the same pace in Q3 and Q4. What are we going to rely on as far as capital formation is concerned? Isn't private sector going to do the heavy lifting, which right now they perhaps are not doing? And is 4.7% a figure you will cheer, or a figure that you will read with caution, given the fact that as a percentage of growth, it may not be so heartening?
No, I will view it with caution. That's a fact. The share of gross fixed capital formation as a percent of GDP has come down a bit actually, which is just marginally though, but it's not nowhere near the peaks of 37-38% that we've had in this country before. So this is again, and let me want to take a bet on this, that this is again the bottoming, the last bit of the private capital formation weakness. And henceforth you will see, just as you are now beginning to see the growth in private consumption, you will see a beginning of a growth in private capital formation as well as we go forward from here. And I say this because of what Moody's said. Because when Moody's were upgrading their rating, they said that there are now much better macroeconomic indicators available for the going future. I mean, S&P, while not improving their rating, also said that they see a much better macroeconomic balance going forward. Also, the ease of doing business having improved so significantly would cheer the private investor. And finally, don't please forget that the government has bitten the bullet and recapitalized the public sector banks by as much as 1 lakh crore. Along with that is going to come a package of governance reforms and consolidation and rationalization of the public sector banks. That would mean that at least one balance sheet problem, the twin balance sheet problem, will be resolved. And then you have now got you got action on the insolvency and bankruptcy code by beginning to invite now investors to take over stranded projects. All of this, to me, Supriya, point irrefutably to the improvement of private investor sentiment going forward. And you will see that happening in the next quarter, that you will see a pickup in private investment. You will see a pickup in investment in the services sector, where the PMI is very strong, and you have seen also that the trade, hotels and restaurants has grown by about 9.9%, 10.5%. So I think the weakness that has remained in our economy is soon going to be removed and eliminated, and you will see therefore both the private consumption, private investment, and government public sector investment all keeping pace. You might have noticed that even the government spending in this quarter has remained constant at 12.5%. So therefore, I'm convinced that the economy will be on a more sustainable growth path, both because of investment and consumption improvement as we go forward.
Dr. Kumar, are you worried at all about agriculture growing at just 1.7%? Is that a cause of concern for you at all?
Not really, because the last year, it's a base effect. Last year it grew by 4%, which was a very big jump coming after two poor years before that. And the average kharif production this year, I think, is still about 6.9 million tons higher than the average of the last 5 years. And I think the Rabi cropping has been very good. The winter rains have been very good, and so therefore I see a growth in agriculture as we move forward. The one area of concern, Supriya, though, is my export weakness. 19.8%, which is lower than 20.7 of the previous quarter, is not good enough. We need more than 20. We need nearer 25% rate of growth in exports, because our current account deficit is sustainable, but we need to bring it down. But much more than that, a dynamic export sector means much more employment, much more multiplier effects, etc. And which is why we in Niti Aayog had set up a task force on employment and exports, the recommendations of which are going to be submitted to the Ministry of Commerce very soon. And these are recommendations of very granular nature to remove constraints and impediments and de-bottleneck some of the supply side issues in the export sector. And we hope therefore that that sector will. But just one second, that we need RBI's help in this.